And after all, we will move to non-standard special patterns, okay? So before we begin, I use this opportunity again because I see people are still coming in this webinar. So if you followed at least my analysis today on euro-dollar, whatever, you should take your profits or put your stop loss to break even or something, because we will have FOMC in 2 hours. FOMC knows to be very volatile. I don't know if this FOMC will be volatile, but it could be, so because of that, secure your profits. Okay? So, breakout trades, we will do a quick reminder of breakout trades, then basic chart patterns and non-standard special patterns. These are all tradable, and I will show you in these examples here how you can deal with it. So since we are dealing mostly with breakout trades, let's do a quick reminder how we trade breakouts. Okay, quick reminder is I will use this slide now. So first of all, guys, you have, and you remember that, I will chart it so it will be easy for you to follow. Let's say that you have a simple support line, okay, a simple support line. You probably remember how I taught you to trade always. There are 3 types of trades, okay? 3 types of trades. There are trigger happy trades, then there are breakout retest trades, and there are breakout pullback continuation trades. So first we see a trigger happy trade. So what is a trigger happy trade? Let's assume this is important resistance, okay? Once the price breaks through this resistance, let's say it's daily high, immediately 2 pips after the resistance is broken, we take the trade. Okay, so it's called trigger happy trade, and the price will usually follow in some number of some number of pips. It will definitely give you profit. At least 2, 3, 5 pips can be made with that. So it's called trigger happy trade. Now, when trigger happy trade starts to retrace and touches this same resistance, we can open another order, or we can use definitely another position here at this point. So it's called a retest. Okay, so trigger happy starts here, breakout retest starts at this point, and once that retest trade starts to develop, it will break out through this trigger happy or breakout point, and in that case we call it breakout pullback continuation. This principle can be applied to every chart pattern we encounter. Let's say that we see, for example, a rectangle pattern, and we see a ranging price action here. Once this rectangle is broken to the downside, after 2 pips, if we make a trade, it's called trigger happy trade. When that particular trade starts to retrace and it touches this X support, now resistance line, you can open another trade, or trade number 2. It's called breakout retest trade. When this point here, before the retrace, or so-called breakout point, is being broken, once it's broken by 2 pips, we call it breakout pullback continuation. So effectively, those are 3 ways to trade breakout patterns. 3 ways. From these standard chart patterns, we are effectively trading head and shoulders, inverted head and shoulders, flat top ascending on flat bottom descending triangle, W1, 2, 3, M1, 2, 3, and N and inverted 1, 2, 3, N and inverted N 1, 2, 3. Okay, so let's see how we trade head and shoulders. So first, this is all now these are standard patterns. After I finish with this, I will teach you how to trade non-standard exotic patterns. Okay? So head and shoulders. Probably most of you know that there were traditional teachings how to trade head and shoulders, which in my opinion are not that bad, but definitely they're not better than modern approach. Today we can definitely make good number of pips when we trade head and shoulders traditional way. But still we can go for an early trade using modern way to trade head and shoulders with less risk. So definitely traders still prefer to use this all-time approach, as I said, but we can also use modern approach and take nice number of pips just by trading rejections from these tops. So let's say that we have a head and shoulders pattern in forming. So once it starts to form, it will first go with the left shoulder. At this point you don't know whether it will be head and shoulders, but you can clearly see something going on in the chart. Then there will be head forming. So once these two important parts of head and shoulders form, you can assume that a pattern in forming could be head and shoulders. Okay? So starting from this left point, it's a left shoulder, it goes right through the head, it starts to retrace, and somewhere around here you think, well, it could be head and shoulders pattern. Now you don't have a confirmed head and shoulders, so you basically what you need to do is to wait for the pattern to confirm. Now the candle starts to retrace, and this definitely looks like a head and shoulder here. But what happens after it? It starts to reject and it hits again. It literally makes a double top here, but from this point on now you can definitely see this is head and shoulders. You don't need to see this part of the screen. Definitely this is head and shoulders by itself. Okay? Or like this. So you can use a trend line. If you go with traditional approach, you will make a trend line here. So you can make a trend line here if you use this as a shoulder, but you can also make it here. So definitely it's almost the same. But because you didn't know what will happen after it, then you will use definitely this neckline here. Okay? This neckline here, because you don't know that the price will go down. Okay, so this is your head and shoulders up to this point. If you trade traditionally, you will wait for the breakout, then you will trade it. Of course, we always trade it with one of three types of breakout trades, which I mentioned 5 minutes ago. So for all of you, because I still see that people are coming in, for all of you who missed the first 5 minutes of the webinar, we have trigger happy trade, we have breakout retest and breakout pullback continuation. Those are breakout trades we tend to trade, and we need to choose one of those breakout entries to start with. So in this head and shoulders example, you can go with traditional approach trading, trigger happy trade, breakout retest trade, or breakout pullback continuation trade. Whatever you do, definitely you need to use proper money management. And usually when you do with traditional breaks of head and shoulders, that means that you should definitely put your stops above the shoulders. And it can take a bit of, it can be a little bit, I cannot say an unprofitable one, but it can be too far from stop loss, especially if you're trading higher time frames. It's okay if it's on 15 minutes. This is not big. But on 4 hours, it takes a lot number of pips for stop loss, and it's a little bit risky. So, if you go with traditional approach, you will definitely use this area and project that area, the same area here, to see target zone. So definitely for risk to reward ratio, it's not so payable. Then there is a modern approach. Modern approach says that if we trade head and shoulders, we can short it at the top of the right shoulder. And that is one of the techniques I also use when I trade head and shoulders. So definitely we can start looking for short trades at the top of the right shoulder. Now it has definitely advantage over traditional approach to take trade head and shoulder trade. First of all, first advantage is if you are taking the trade at the top of the right shoulder, you will be trading the price. So the price will come to this point, so you don't wait for any breakouts, you don't have any trigger happy trades, you just wait for the price level. So assuming this was the top of the left shoulder, and this is indeed at this point when it happened was the top of right shoulder, you can assume this is going to be head and shoulders, because you will see this pattern and it really looks like head and shoulders, but you're shorting it now from the top of the right shoulder. And what that means, stops are put here, and look at this, profit is running, and still you have the possibility to enter with one of three breakout type trades. Trigger happy trade, breakout retest trade, breakout pullback continuation trade. Okay, so these are three types of breakout trades. So if you trade head and shoulders at the top of the right shoulder, you will have a smaller stop loss, and you still can have big profits, and you still have the chance to enter scale in. It's called scaling in. That means that you're adding into position. Once this neckline is broken, you can go with breakout retest trade or breakout pullback continuation, or you can scalp it with trigger happy trade. But definitely start thinking a little bit differently. Start thinking that you can also take head and shoulder trade at the top of the right shoulder. So let's say that you have seen this pattern here, and the price starts to approach this zone. Now it's rejected, and this was a second chance trade. So you can basically take a second chance trade if you missed this first one. But if you know what head and shoulders is, you can easily identify this at this point, while this candle was forming, was a live candle, that this could be head and shoulders, so you can short it from the top of the right shoulder. This is confirmed head and shoulder in this example. We have left shoulder, head and right shoulder. Once this left head and right are aligned, we draw a neckline. And once this neckline is broken, we go with the trade. It's okay, as I say, it's a traditional approach. But modern approach teaches us that we can also trade from right shoulder, to the top of the right shoulder. This is also one of the examples of head and shoulders. You can see this could be something, but this is definitely left shoulder. This is right shoulder, and guys, if you short it from this point, look, it's still bigger profit. It's in a bigger profit than if we would trade it here. I'm not saying that traditional approach is not good, but you know, being a forex trader, last 8 years, I really did a lot of charting, a lot of screening time, and what I can say is we sometimes need to change. We need to change ourselves. We need to put some changes in our life. And one of those changes is how we trade traditional patterns. Why wouldn't we try to short it, even though if we don't know whether this will be full head and shoulders? Because you know, in this point, you cannot say, because if you see this candle, you don't know what happened after. It looks like it could be, right? But pay attention, guys. This is double top, right? Here, it's double top. This is almost triple top. And look at this candle, it's been forming. So it's not a big risk trade, let's say, to take this trade here, put your stop loss here. Because if you would trade this short here, you should put your stop loss here or there. Okay? But still there is a bigger chance for your trade to go down. Not just it will be definitely head and shoulders, but you see double top, you see previous top, and you see something that really, look at this rejection candle. It's telling you a lot. And look at this. The same rejection. Then you will be in a drawdown, but eventually if you are patient enough, you would be in profit. So again, another example of head and shoulders that you can trade it both ways. But if you take the trade from this point or this point, you go with price action. So you go basically with the price. If you take the trade here, you go with trigger happy trade. Then you should drop to 15 minutes to see if there was a retest here. So you can enter retest, and finally continuation happened here. But as I mentioned many times before, breakout pullback continuation pattern is not so good as it was 5, 6 years ago or 10 years ago. Because I know that many traders, before I started to involve with Forex, I know that some traders were telling me that breakout pullback continuation pattern was very, very profitable. Then I started to, basically I was a little bit suspicious because I was trading head and shoulders on traditional way, and not just head and shoulders, all breakouts which give me breakout pullback continuation patterns. And those traders which were trading back in time were basically swearing the price action at that time, because breakout pullback continuation is good if you have 200 ATR pip range. But if you have only 19 or 100 pip range, it's not so good, because you wouldn't get many pips with this pattern. So I started to doubt that, and yet when I start also trading professionally, I definitely start to trade head and shoulders from the top of the right shoulder. And it's very, and you could have noticed that in my analysis, it can be very profitable. Yet another thing to pay attention to when you're trading head and shoulders is this. This is breakout, okay? And we see that this is 1 hour chart. So you need to drop on, let's say, 5-minute chart to see if in this candle was a retest. If you don't see a retest, then you definitely miss the retest trade. So the next retest happened here. So if we didn't see, because this is 1 hour chart, we zoom in 2 times lower the time frame, so it's 5-minute chart. If we didn't see any 5-minute rejection of this region here, it could be that rejection happened here, and then bang, it proceeded down. Because every breakout needs to have a sort of retest. And if this was a breakout, and it was a breakout, we should go to 5 minutes to see if there was a retest at the same candle. If there was a retest, we can go with another entry. But if there wasn't a retest, well, this is a retest definitely. Okay? The question David is asking, if you trade the right shoulder, I suppose the win ratio will be lower than if you trade the breakout. Is it true? David, I'm not so sure about it, because it depends how you approach the trade. The pip gain will be definitely great, but also your win ratio can be great. But you need to see if there is a left shoulder there. Look at this, it's a left shoulder. This is also can be considered a left shoulder. But if you don't see any shoulder, you see just this, but it's obviously left and head, right, at this point. You can assume this is resistance. So you can place your stops here, you can place your stops there. But what I noticed, if that is indeed head and shoulders, you will have good win ratio. But if you go with scalp trade, then you will have great ratio. For example, you shorted it here and this is 30 pip drop. If you took this 30 pips without even the confirmation of the head and shoulders pattern, you're still good 30 pips. Maybe there wasn't a movement of 30 pips. It was, but let's say, we don't know. But this was definitely the movement here. And you could have scalped this. And even this one, look at this. This could even be better. Another confirmation for you to go short. Because it's still top of this shoulder. And bang, it goes down. Your head and shoulders pattern will not always be like this. It wouldn't always be like this. You will have slight variations such as this one. But you know what is important in head and shoulders? This. Head, left, then head. As in inverted head and shoulders. Left and head. Once you see left and head, you start to assume that it could be head and shoulders. Okay? Now, this is the example of inverted head and shoulders. And I intentionally put this, inverted head and shoulders, because the principle is the same, guys. You can wait for a neckline break, or you can long it from the bottom of the right shoulder. I advise, if you like to trade price action, I advise you to check this on your charts. Find inverted head and shoulders, find head and shoulders, and just count the number of pips you could have made with shorting it or longing it at the top or bottom of the right shoulder respectively. Left shoulder, head. This could be assumed as right shoulder. So even here at this point, it could be good trade. Okay, you've got your pips here, you close the trade. The price continues to form. At this point, left, head, right shoulder. Completely confirmed pattern. And look at this neckline. So, if you trade from the bottom of the right shoulder, you have basically 1, 2, 3 chances to go long. 3 chances to go long. And then what happened, the price, and now this is interesting. You put your entry here, you made your pips, but you decide to leave it. Trigger happy trade, breakout retest trade, breakout pullback from this point, continuation trade. So there is a lot of possibilities if you trade these price action tools. Really a lot of possibilities. Okay? So left, head, right. 1, 2, 3 chances to go long at the bottom of the right shoulder. And look at this, bang. Now if you see this pattern, you can obviously place your stop loss here. Or if you trade traditionally way, you can place your stop loss below this point. So trigger happy trade, executed 2 pips above neckline break. Breakout retest trade executed at the touch or very close to the touch of this neckline. 2 pip is okay. And breakout retest continuation or breakout pullback continuation from this point. So you obviously need to place your stops below this point. Again, example of inverted head and shoulders. It's pretty clear that you can see this. Left, head, right, whatever. Even though this could be assumed as, look at this, as the right shoulder, but sometimes the price will make another part. So this is first chance, look at this. It's not so far from this region. 1, second chance to go from the bottom of the right shoulder, and you are in a profit. trigger happy trade. Now look at this. This was a retest, and the retest also made some profits. If you took profits here, you would have won. You would have won. But obviously, if you didn't take any profits here at this point, then you will be stop loss, okay? So that is why I always tell you, and David, referring to your question, it's important how you approach the trade. Whether you want that trade to be a scalping trade, or you want that trade to be, I don't know, positional trade, or you want to be that long-term trade, it depends of your approach. In this example, we could have made money with longing at the bottom of the right shoulder, longing at the bottom of the right shoulder, making trigger happy trade, and definitely it was not so profitable, but yet again, for some 20 pips, it was profitable breakout retest trade. Continuation trade would be definitely after this point, but there was no continuation. It happened afterwards. This was new spike, but this was not. There was no continuation here. We use same principles for trading also triangles. So this is flat bottom descending triangle. Breakout. This is trigger happy trade. This is breakout retest trade. At this point, it's breakout pullback continuation trade. Okay? Then we can, sorry, I lost my mouse. Here it is, but I see problems with this PPT. I don't know why it stopped. Let me wait, guys. Just let me fix this. PowerPoint is experiencing some problems, so let me fix the slide. Okay, it totally. So I will definitely need to open the same slide for a second time. Okay. Oh, it doesn't let me. Wait, guys, there is a problem with PPTs now. I'm not sure why this is happening, but I will definitely try to close it from my task manager. Okay. Okay. Now let me try to restart it. Yeah, it's good now. It works now, so I can continue. Okay. So this is obvious. Breakout, trigger happy trade, retest trade, continuation trade. You have Forex virus, yeah. Justina is saying Forex virus. Okay. So if you trade this triangle, usually the safest way to trade this triangle is when this bottom trend line breaks, because this is effectively down movement. So this is bearish pattern. You see, you have a trend line here, so it says this is downtrend, and when this lower trend line breaks, you are good to go, because it's a little bit awkward to trade this. Okay, so it can break out to the upside, but usually you take breakouts to the lower part of the triangle. Now this was another example where we didn't have any breakout to the upside, but we experienced a breakout to the upside. Okay, so this is double top, and we want to see this double top broken. So if this candle was going like this, you would assume that there is impending breakout. So trigger happy, then retest, continuation. At this example here, this is definitely breakout, but probably there was a retest and continuation came from this point. Okay, this is one of the analysis I did for euro dollar, and you can see that there was a triangle here and W bullish pattern, and this was basically these two candles here were breakout pullback continuation trades. Okay, so you're approaching the same W, standard W pattern, where you traded at the break of the second point. So if this is 1, this is 2, this is 3, when this point breaks 2, you go with breakout, trigger happy, breakout retest, or at this point breakout continuation trade. Okay, so this was effectively W pattern. Okay, W looks like this, and you're trading the break of this point here with one of those 3 ways to trade breakouts: trigger happy trade, retest, and breakout pullback continuation trades. M pattern, same goes for M pattern. When you see M pattern formed, the lowest point of the M is tradable. Okay, so this is 1, this is 2, this is 3. At this point, obviously trigger happy. This is daily chart, so it definitely made some movement here, but this was even better example. This was a true breakout, retest, continuation, and you can see usually those trigger happy trades give us some number of pips. Okay, do you see the screen now? You just I noticed that there was no screen. Okay, now it shouldn't be frozen. Is it okay now? Just confirm that you see my screen. Great. So definitely the problem was solved. So I will repeat once more. When you see W pattern, you have point 1, point 2, and point 3. When you go from point 1 to point 2, you still don't know whether this is a valid W. But at the break of point 2, there will be a potential to trade this pattern. Okay, so W looks like this. You see there was a breakout at this point. So we see a breakout trigger happy trade, breakout retest trade at this point, and breakout retest or pullback continuation trade from this point. So it's W pattern. This is the same, W in the triangle. So you can see at this point there was breakout retest trade. Okay? Then there is M pattern. And as you can see, it's on daily chart. And most of the time you can see that trigger happy trades are giving some number of pips. So if this is M, and this is definitely M, this is trigger happy trade because it's on daily chart. Even this slight wick gave us some number of pips. But then it was basically we don't trade, I don't know, I don't trade such big time frames, but use this slide for showcase purposes. You will trade 5 minutes, 15 minutes, 1 hour. The same principle. M, breakout trigger happy trade. Then there was no retest. Here, a trigger happy trade, and there was no real retest. Here at this point we had a trigger happy trade. This was a retest, and from this point there was continuation. So usually, guys, one tip for you, pro tip, if you see breakout, retest, and you're still in the trade, let's say you're here, you enter here or you enter there at the trigger happy trade, once the price starts to approach breakout point, you can add on, you can make an add-on to your trade. Because if this breakout point is broken, that will be breakout retest continuation, breakout pullback continuation trade. So you effectively can have 1 and 2 potential entries. So this usually means with a proper retest that the price will continue to break down the lows. And we could see it here in this example. This low was broken, the price retested this low, proceeded to go down from this point. And standard and bullish pattern, you know how it's, sorry, this is bearish, this is inverted N, this is bearish pattern. So inverted N looks like this. In Cyrillic, this is a letter I. So letter I in Cyrillic looks like this. I call it inverted N. When you see inverted N, you're still following the same principle. If you were following my premium webinar and you visited my premium webinar, I gave you 1, 2, 3 pattern indicator, and this is the screenshot from 1, 2, 3 pattern indicator. So basically, when you see 1, 2, 3, you're effectively trading again the second point. So 1, 2, 3. So you're trading 2 pips below this point, and this is here, 2 pips below this point here. Okay? So it's inverted N, and we are trading it the same. Breakout of the second point. This is bullish N pattern because it looks like letter N, lean N. And you can see it here, 1, 2, 3. Same principle, use the indicator to show you. The indicator is 1, 2, 3 pattern. I gave you for a premium webinar, and you trade it like this. 1, 2, 3, 1, 2, 3, breakout of this point is basically your entry. 1, 2, 3. Some people though can also trade this inverted N and N from the Fibonacci levels. So the indicator will automatically plot Fibonacci levels, and you find those entries around these two levels, namely 38.2 and 23.6 in this example. And in this example, you usually will find those entries on same levels, 38.2 or 23.6, because they use it like a deeper retracement. So you can make your entry here, or you can make your entry there. But usually the pattern is traded as this way. But you can also trade it like this one, making basically a better price for your entry. Now we have also non-standard and special patterns, which I explained you already, but I didn't explain how to trade, so I will do it now. Hook reversal, 3 Buddha top or 3 Buddha bottom, it's the same. Cup and candle, Adam and Adam, ascending scallop, running triangle, diving border, V-shaped reversal, and rooftop. Some of them are tradable, some of them are not tradable, and I advise you to stay out of it, because you cannot trade each single of those patterns. Some of them, as I say, are tradable, but definitely some of those are not tradable and can be very, very dangerous to trade. Okay? So let's see. Hook reversal pattern. Hook reversal top is not tradable pattern. Why it's not tradable? It's only a signal pattern for you, and that signal pattern is telling you that the price will reverse. So if you see this pattern, you don't trade it, you just know that the price will reverse, and that is why it's called hook reversal top. So you are ready to take short trades. If you are trading intraday, let's say this is 4-hour time frame, you see this pattern, so you zoom into 1 hour or 15 minutes and wait for short trade setup. Because this is a reversal pattern. This is bearish reversal pattern. So you don't trade this pattern. You use this pattern as a cue that the trend will turn from uptrend into the downtrend. So it's called hook reversal top. Okay? Hook reversal top. We see also hook reversal bottom. So you don't trade hook reversal bottom. You definitely use hook reversal bottom to tell you that the trade will change The trend is about to change. Okay? So once this pattern has been formed, okay, you just zoom into your lower time frame and try to find a long entry. If you're not sure what these patterns mean, I did already the webinar with Admiral Markets. I think it's uploaded, so you can find out how these patterns are formed and how you can define them. So today I'm talking how you could trade them. Okay? So non-standard special patterns are not tradable. This pattern. Some of them are, some of them not. Yeah, this can be double bottom, but you don't know if it's a hook reversal bottom, because this double bottom does not tell you anything unless you see these two. Basically, this is very important. This, you just use it like, don't look at this part of the chart. Concentrate on this part of the screen. So once this candle breaks from this point here, you assume that this could be a hook reversal, and you can see this is low, this is high, this is lower, this is higher low compared to this, and this is higher high, so it's uptrend. So it's early sign for uptrend. Okay? So you assume that the price will go up, and you just zoom into lower time frame and try to scalp or trade long entries. 3 Buddha top. Definitely tradable the same as head and shoulders. You see, it's not, it looks like head and shoulders, but look at this. We have 1, 2, 3 tops. And sometimes those tops can be shown on your shoulders. It doesn't matter if it's left or right shoulder. You have 3 tops. It's called 3 Buddha top. 1, 2, 3. In this example, we have 3 tops here, but we can treat it basically the same as head and shoulders, except it's called 3 Buddha top, and you can trade it from this point, and you can trade it from this point. The same as for head and shoulders. This is also 3 Buddha top. This could be left shoulder, but it isn't. This is left shoulder, 1, 2, 3. This is head, and this is again right shoulder. This is the neckline. Okay? It connects 2 lows and breakout, so you can short it here. And guys, use your logic. If you see, these candles are bearish candles. And in this example, you see there was a bit of history of selling in this region. And you assume there will be a bit of selling in the same point as it was in the history. You see multiple rejection candles. So definitely you assume the price will go down. And look, it went strongly down. So again, shorting it from the right shoulder is a profitable option most of the time. You can short it here, but you know, it's a little bit, it's a bit too low to short it, even though it's a break of neckline. Cup and handle, you can trade this pattern. It's tradable. So you define cup and handle. This is handle here, because you have these 2 trend lines which act as a handle. So how you trade it? Simple. Wait for the breakout of the candle. Breakout, trigger happy trade, pull back, look at this, good pullback. Breakout retest, and from this point continuation. Okay? Cup and handle. Define cup and handle and wait for the breakout. Trigger happy, breakout retest, breakout pullback continuation. Adam and Adam, the same thing applies for Adam and Adam as for W. But Adam and Adam has double bottom. So it's usually good to place your trade here, and you go with a breakout of this point here. Once this is shown on your chart, you treat it as W bullish. So at this point, you can see it was tradable. So the only difference between Adam and W is that Adam has double bottom. W can have, or it, you know, sometimes it doesn't have it. But Adam has double bottom. And you still are trading at the break of 0.2. Because it's how it's traded. It's how it's traded. From the breakout of this 0.2. So this is 0.1, this is 0.2, this is 0.3, so this is 0.1, this is 0.2, this is 0.3. You trade it after this. Okay? Ascending scallop is not tradable, but it does tell you that the pattern, that a trend is to the upside. It looks like inverted cup and handle. Look, this is cup and handle, and look at this. But you know how I say for this pattern? I say it looks like letter J. J in English. Okay? Look. Ascending scallop. So it gives you the hint that the trend is to the upside. Now guys, a quick reminder, euro dollar is 13.60, so if you didn't close your profit, now from the entry I have put on analysis today, you are good for at least 50 or 40 pips. Okay? I'm in the trade, I will close it now. Definitely, it's only 1 hour till FOMC, so now, because I know that many of you trade my setups, so I just want to tell you what I would do now. I would close the trade now. It may go to where I said 14.65, but you know, I already made a good number of pips today, so I am pretty much satisfied with it. Okay, let's get back to webinar. Ascending scallop looks like letter J, so it's not tradable. Okay, it's not tradable. Yeah, and it looks like a fish hook. Yeah, indeed it looks like a fish hook, Tavi. And Claudio is saying, yeah, definitely. So good, guys. I see some comments here, so. Yeah, it looks like a fish hook, but, you know, it resembles a letter J. So ascending scallop, okay? You know that when you see this, you should go for a long trade. So you put your Fibonacci retracement and bang, you can trade it. You don't need any system to tell you this is bullish pattern. Once you spot bullish pattern, ascending scallop, you will know that you just need to zoom in a little bit lower and use long trade entry, because this is long term. Because look, it looks like cup and handle, and this top was broken because this is J. When this hook here breaks, it's definitely bullish. We see running triangles, so this is how running triangles look like. Okay. And this is the good example of a running triangle. The triangle which does not have vortex. So every triangle has a vortex. This is vortex, pinnacle of the triangle. When you see that there is a shape of the triangle, but it does not have a vortex, we say this is running triangle. Okay? And look at this. So from this candle you could have traded breakout, trigger happy, breakout, retest. Probably there was a retest or no if this is 1 hour chart. So you zoom into 5 minutes to see if there was a retest, and from this point continuation. Or maybe it was a trigger happy, bang, straight to the upside. But running triangle, what did I say about descending triangle? It tells you it's good to trade this break. This running triangle, because it has ascending trend line here, it's better to trade it from the top. Okay? Now this was again another example. It would be better probably to take traditional trade from the top. if the candles went like this, but obviously there was a breakout to the downside. Again, triangles can be traded both ways, but you know, I often wait for the top line to break or the bottom line, whichever is horizontal. But definitely, again, trigger happy, maybe a retest, and continuation definitely from this point on. Diving board or V-shaped reversal. When you see this pattern, do not trade it. We don't trade this pattern because it tells you that, guys, check your euro dollar. Today it made V-shaped reversal. So basically you don't take any of these trades because you see it was a huge downtrend. I did my analysis before I saw V-shaped reversal, but it was good because we are in the profit now from euro. But look at this, a V-shaped reversal. It looks like letter V, okay? So it tells you that the chart and this market will go to the upside, probably, but you don't trade it because it's a reversal. It's too high now to go long. And usually it precedes or it is happening after the big movement or some news. Rooftop, you know, rooftop can be traded. If you see a rooftop, you see it, it looks like this. So head and shoulder is this, and rooftop is usually looks like this, like a roof. And you just draw a trend line and wait for the breakout. And this was trigger happy, this was breakout, this was retest, and from this point here it was continuation trade. So guys, this was everything I had for you today. If you have any questions, you can ask me now. Okay, so if you're clear with this, even better. The quick summary of this webinar is use your 3 ways to trade breakouts. Breakout, trigger happy, then breakout retest, and breakout pullback continuation. All of these patterns, most of these patterns are tradable, but some of them are not tradable. They give you the cue where the trend is going to be, okay? And definitely sign in for new recap because last session recap again was very, very profitable. Euro dollar, cable, New Zealand dollar, we had great trades. Until tomorrow, guys, I wish you to trade safe. I will be with you very, very soon. And of course, as always, if there are any questions, feel free to ask. Okay, I don't see any questions, so we can assume the webinar is over. Thank you for your attention, guys, and I really wish you to trade safe and do not try to trade during FOMC, okay? Trade safe and talk to you soon. Cheers.